Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
And we're thrilled that his Taylor drops here. Our surveillance Swift correspondent, Wu Silverman, joins us today. But the timing here is so important. I'm not going to give you any Taylor chat much today. Amy, she's had a derivative strategy, RBC. What do the cross moments say about this moment for America?
Well, look, the last time I came, Tom, we talked a little bit about the left tail and the right tail. And, part of our conversation was that I still felt like investors were more worried about that right tail. And here we are with markets at all-time highs, skew is relatively low. All the hedges that had been placed were not monetized because the markets kept going up. And when I talk to investors, they say this just feels like the most reluctant rally.
Roman Friedman, NYU, I think he's brilliant, very controversial in economics. He would say the re-hedge will kill you. Inside baseball, we've had this bull market. The hedges weren't monetized. They got to go out and re-hedge. Can they re-hedge opportunistically here?
They certainly can. And of course, because everything's come in from a volatility perspective, it's not that expensive. But the reality is nobody's going to, because markets have very short term.
Simple as that. Like Taylor in her new album. See how I got that in, Paul? Thank you.
I love it. Because when you're burned once, twice, then shame on you. And so, you see it in some aspects of the market. You do see it in gold, but you don't see it as much in VIX, and you don't see it as much in S&P hedges because that concentration risk keeps pushing the right tail to be more the fear than the left tail.
Can I editorialize from one Sweeney and Keene? We are so lucky we're not running money right now.
Exactly. Are your clients looking to buy protection, or is it, or not? Because I look at a VIX. That's the only thing I kind of look at because I'm simple, and I don't see a lot of fear out there. So what are you seeing on your desk?
So I will tell you, post-Liberation Day, we did have that big rally, and investors did hedge, and a lot of it was longer term. So a lot of it was for that September FOMC. And then when that came and went, not in the direction they had hoped from a hedging perspective, none of that premium was rolled. What investors tell me right now is they're looking at alternate venues. So that could be, call options on gold. Even though that's run too, they at least feel like it's a little bit less correlated. And then what they're waiting for is, and I'm interested in what consensus is here, but I think if we get any sort of 5 to 10% drawdown, investors are actually going to buy that dip still. It's actually, that's why I think you get this market that feels nosebleed, and yet we're still doing that right tail chase.
So in the Greek letters, the one that I look at, folks, this is from aerospace engineering, is theta, which is time, guessing the time function, measuring the time function on the x-axis. Can you do a theta study now? Or with a shutdown, no jobs report, all the other distractions, Taylor's drop, you can't measure out on the x-axis right now? Is that what this is really about?
Yes and no. And you know what I would say, Tom, in terms of theta, it's good from the perspective of if you were selling that volatility premium low as it is, because everything's been kicked, it's good for someone who's just riding it out, right? Because all the event risk has now been pushed out. The question in options is always a timing question. Right now, the options market is pricing that we will get a resolution before the October FOMC.
I got to get one more nerd question in here with Wu Silverman, RBC. Good morning across the nation. Good morning, global and American Wall Street. We're thrilled you with her work at Princeton and all that she's done for the Royal Bank of Canada. Wu Silverman, really treasured here as well. What Taleb would say, fooled by randomness, is forget about all this pro-Wall Street thing. Look at the hedge fund report from Catherine Burton yesterday, the non-performance of hedge funds. Taleb would say you can't figure it out. You take little bits of money and go way out theta, way out, and buy the bet you want to bet. Is that efficacious now?
Look, and there are tail funds that do that. And it's a function of why do we go so far out? Because we don't know exactly when the timing is, but we do feel like that reckoning could occur. And of course, it's not that expensive. But again, markets are very short term. We just got burned on the September FOMC not going your way, and you place those hedges, and now you're dragging a little on something that's ripped. Right. It's very hard to talk people into stuff like that.
Nerd folks, but I just tell you, you're getting a window here into the real world. Jordan Rochester over at Nomura, Mizuho, you can't even understand his report. It's just Greek to me.
Too much Greek there. Yeah. Amy, who are your typical clients on your desk? Are they hedge funds? Are they long-only funds? Who's a typical client of yours that really wants to talk about options and hedging and that type of thing?
Yeah, I would say it's a good mix. So there's long-onlys, asset managers, there's pensions, and then there's hedge funds. I'll tell you, hedge funds can be a little bit more nimble in what they do. And what we've seen a lot of them do is rent the small cap rally. So, they don't want to go all in. So you're seeing a lot of these IWM call spreads, which on an absolute level have actually done fine because they're saying, we don't want to wait. We don't want to sit on this concentration risk. When we do see some sort of spread widening, in that case, it was the volatility spread between IWM and Qs, let's take advantage of that. So you are seeing nimbleness from the community that can do it. I think it's a little bit of a struggle, for the long onlys. However, if they've been in the right handful of names, they've done okay. And if they haven't, that drag is quite painful.
Dumb question of the day. Do your clients want to hedge their fixed income portfolios as well? And if so, how do they do that?
They certainly do. That just wouldn't be my alley in the sense that we only focus on equities.
Okay.
But I will tell you, there's been a lot of translation because there's so many liquid fixed income proxies. So an HYG or a TLT, you're seeing fixed income focused hedge funds and asset managers actually traffic more in equity derivatives because there is a decent amount of liquidity in these proxy ETFs.
On the equity side,
I have no idea what you just said.
Do they hedge with ETFs? And so how are ETFs, how's that change your world?
For us, it's changed for the better because I just feel like there's more tools in our toolbox. 20 years ago, I couldn't say, hey, go out and buy an HYG, so the high yield proxy ETF put spread. You wouldn't get that liquidity nowadays, especially because I think at the end of the day, everything is rates focused. No matter if you're a tourist or you're specializing in it, you use these as something that you would do instead of CDX, and it's relatively liquid and it gives you timing.
So that brilliant phrase, which I totally agree with, from painful losses, can I suggest that part of the rates focus is what's driving Mag 7 higher, which is a recalculation of their cash flows and terminal value?
100%. And, the one thing I'll say, the big change to me post-COVID is you can't rely on these traditional correlations, right? You can't rely on your hedge just being a 60-40 portfolio. I think Mag 7 changed a lot of that. And then you look at the intercorrelation between Mag 7, which has been relatively low, and people are scratching their heads and they say, how is it that you're all integrated into each other's supply chains, that yet this correlation isn't that high? And so I do think that's why you're seeing these different expressions of hedges, Tom, that weren't necessarily the case 5 years ago.
Amy Wu Silverman, RBC, with us, an extended conversation, a treat on a non-jobs day Friday. At 8:30, Claudia Sahm will be with us. We're honored to have Dr. Sahm with us today. So within the Mag 7 and all that, there's a recalculation here. How do you take the fundamental story and how does that look? Like when you look at, can you look at the cross moments of Microsoft? I mean, what do they look like?
Absolutely. So one thing I'll tell you is when we were basically 4 or 5 years ago at this point, when the AI news was slowly starting to become part of the conversation, the first time you really saw that bullish element was in NVIDIA calls. So they started to skew invert. All that means is the call option bid became so vast relative to the put option bid. Before that happened, the only time we saw that level of exuberance was in the meme stocks. And when people saw it on the meme stocks, they said, this is a tempest in a teapot. This isn't going to happen on bigger names. And then guess what? It happened on all the Mag 7 names. And so now the market has really started to pay attention to the Mag 7 cross moments because they determine the cross moments of the entire index. This is 25 to 50%, depending on your index, and you have to watch it.
The cross moments, folks, are starting with variance, the different dynamics of the moment. For example, kurtosis is the fungus Lisa Mateo's daughter has between her toes. It's also, I think it's the third cross moment, or mesocortotic, leptocortotic something like that, Paul. Amy did better on this than me.
Exactly. Amy, talk to us about liquidity in your marketplace. If you come up with a nice strategy for your client, can that actually get executed efficiently in the markets today? How has liquidity changed in the futures and options market?
It's been incredible. So first, liquidity, depending on what you're trading, your standard suite of indices or Mag 7, what have you, highly liquid from an options perspective. The second thing I would say is we've had a lot of duration shrinkage. So the folks
duration shrinkage?
Yes, duration.
Oh,
so the tenors of the options that are traded, and this is a huge theme for us. It used to be that 1 month was your short duration, and then it used to be 1 week, and then SIBO came out with a lot of 0 day to expiry. Yeah. And that's been the duration. So things happen very rapidly in our markets. But at the same time, guys, we also get less of a signal. So, that GPS that used to give you maybe 1,000 feet to make that left turn, we're getting like a day now because you don't see people place those bets until 1 day before. So I, as a strategist, can't read it until 1 day before. So on the 1 day
paper that I don't understand, if you get a jump condition one way or the other, how does that affect mere mortals out there with a long-term horizon of 1 week or 1 month?
That's why if you look back to what I would consider crises, so where the market kind of gives you these 1-2 standard deviation moves, the velocity, Tom, is much faster. So think back to April 2024, think back to Liberation Day this year. The velocity of those moves up and down, that's a really sharp V.
Can I go full nerd end?
Yeah, go.
So it's slew rates. That's what you do. You take electrical engineering folks and you're sitting in a classroom at Princeton and you're going, why am I in an engineering course if I'm looking at finance? It's about slew rates. Are the slew rates for our 401k the same as they used to be?
I think in the sense that if you have a 401k, you're supposed to kind of close your eyes and not worry about it. So in that sense, if you're a long-term investor, I don't think it really changes anything. However, if you're us and you live and breathe this day in and day out, and then you're someone on the other side who's got a quarter end to worry about or month end marks, it does become a little bit problematic because you do have these potholes. I like driving analogies, even though I don't drive. And there's a lot more potholes that could happen than when the tenors were a lot longer.
Brockton's daughter has Taylor coming in new from Target today. Target's promised they'll deliver it today. How will the Silverman house consume the new Taylor?
Tom, I have 16 tickets to the Taylor Swift release party tonight.
Wow.
For my 7-year-old and my 11-year-old and their friends. So I'm bracing. You're welcome to come.
Where do you go?
It's like at a movie theater where I don't even know at this point, but there's a lot of glitter involved and nail art and tattoos.
Boy.
So I'm getting ready. I might need a drink before then.
Yes. Will your offspring dress appropriately?
They've been planning this outfit. This is part of the arc. So
what are you smiling about over there?
She's right. The girls planned for this for a very long time.
It's very cool.
That is. Yeah.
So they all go to a movie theater and there's a video of something.
I believe she's got some, behind the scenes. I don't know, but that's my guess.
The Beatles. I think it's the same. Tom, I haven't seen anything like this.
That's brilliant, and that the only equivalent was Beatles Stones 1964.
Yeah, just
I will say this, folks, and I listened on headphones. I previewed all the songs to give you the songs. Amy called up and said, I'm not coming on unless you do all Taylor. And it's all out of Virginia Beach. There are these miracle people in Virginia Beach. John Haynes, a giant named Serban Ganeo, who's very private. And Taylor's albums are manufactured, essentially, by 3 geniuses in Virginia Beach. And the sound, when you put it on, nobody's sparing a penny here. It's world class. It's world class fidelity. Amy Wu Silverman, thank you so much. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Our conversation of the day on the American economy. Claudia Sahm joins us, chief economist at New Century Advisors. Normally, jobs day, what do you think? Da-da-da-da-da. No, we're not going to do that. She's out of Michigan with all of her front-rate Federal Reserve academics. Dr. Sahm, not on the recession, but on the spirit of the American economy. Claudia, you got a great line which alludes to my book years ago, which is a steal from Ken Rogoff. Are we flying on one engine? You say we're not. You say we have impaired vision. Define America's impaired vision.
Right. Well, I mean, this is the time where we come together every month and wait to find out the latest, the best reading that we have on what's happened in the labor market. And we don't have it today. Like, we're not going to have that discussion. So that, to me, we're not flying blind. There's a lot of information about the economy that we're getting, even as the federal government has shut down, but we're missing a really important piece of information. So our vision is impaired. And what's really frustrating is the September employment report exists. Right. Like, these numbers are sitting there. It's just because the workers who would normally put that up weren't deemed essential. We're just speculating today. And that's really unfortunate. On
a news basis, Dr. Sahm, does the President of the United States get briefed on the numbers that exist that we don't see?
Given the timing of the shutdown, it should not have made its way all the way to the president. Typically, the president, also the Fed chair, would see this employment report the night before, so Thursday night, and the government shut down on Wednesday. But it is the choice of the White House at the end of the day who are the essential federal workers. So it is a choice of the White House as to whether or not we have these data this morning or not.
All right. Claudia, in the absence of the government data, maybe a little bit more attention is focused on the ADP employment number, a decline of 32,000 in September and a downwardly revised decline of 3,000 in August. I think that caught some people by surprise. How did you look at that number?
Right. So absolutely, we should be looking at the private sector numbers. ADP often gets a lot of interest and attention. One thing that ADP does is in September, it's a time where they update their model to help them take, what they're looking at are the clients of ADP. They're a large payroll processor, but they don't process every payroll in the country. And so they need to use data from the Bureau of Labor Statistics to take their client data and make it more representative of all all payrolls, all businesses. And unfortunately, that happens in September. So, and they told us in the press release that updating their model, that actually shaved a good bit off of their September and also their August numbers. So I think it's important in the release, they stress that, even after they did the benchmark revision, pulled in their new data, the trend was unchanged. Right. So they are seeing a slowing in job creation. But I think if you look at the headline numbers that ADP printed, you might be like, oh, wow, the slowing is really picking up. Right. That sign of deterioration that we're all so worried about and watching for. And even ADP in their release, that was not the way they interpreted their data. So it was just another mark. And job creation is really slow. And this is that feeds this narrative of the downside risk.
Claudia Sahm with us. So we're getting briefed here. And of course, we do better with Claudia Sahm. Governor Myron will be with us at 9:32 this morning. That is scheduled. Claudia, back in your ute, I'm sure at Michigan, you were doing the University of Michigan's research seminar and quantitative economics, the Michigan State output gap. Can we measure the output gap that Myron of Harvard is so fired up about? Well,
output gaps are any measure of slack, frankly, is going to be an estimate, right? You're going to need a model. You're going to need to make a lot of assumptions. So we can certainly have differences of opinion about how those are put together. But, the ingredients of, because at the end of the day, the thing that we don't observe, we get measures of, say, GDP growth. Right. These are estimates. They get revised, but we can go out and measure that. The thing that's important for the gap is you have to get an estimate of what's potential. Like what's the best we could be doing. And that's the piece that, you can have discussions and big changes in immigration. Like that can affect what potential output is. Big changes in technology and productivity, that can affect what potential output is. So, I think it's an art more than a science to get at those. But, that these measures of slack are are really important. And I will mention, bringing it back to today and the data we're missing, the big thing that we don't have from the private sector is we don't have a measure of slack in the labor market. The unemployment rate is one of those, fits in that measure of like workers looking for work that don't have it versus workers who do have work.
Claudia, what do we know now with a little bit of experience here about the closing of the southern border and that's impact on the U.S. labor force?
Yeah, the immigration statistics, what we need are the information from the federal government on the, unauthorized immigration into the country, the deportations. I mean, there are data that are published. I think some of those have been more lagged than in the past, but it really is our population estimates, which the immigration is just one piece into it. They tend to come with very long lags. So I think this, because policy has changed so much and so rapidly, that there's both, reporting lags and then just putting all the pieces together. So I think we know the direction, like we can sign this in terms of like immigration has slowed down dramatically, but to get really precise, and particularly in these decompositions of like, oh, well, job creation is down to 20,000, is this high or is it low? What's the break even rate? Those very precise calculations, we just don't have the input data to make, those fine points. And we probably won't for some time.
And Claudia, just away from the labor discussion for a moment, the other side of the Fed discussion is inflation. What's your view of inflation right now in this economy?
Right. Well, inflation is elevated. It has been elevated for some time. I think it's in the space of, it's still a problem. Right, 3% inflation is still higher than what people have been used to, particularly before the pandemic. And the longer it lasts, it does add up. Right. And so it's a problem. I wouldn't assign it as being an acute problem, and I think there are reasons to expect it to come down. Now on inflation, I think this is a place where we really are much more flying blind if the federal government stays closed. We do not have as much data to keep watching this.
Claudia, we've got to run. I can't wait to have you on for a real jobs day again. Dr. Sahm has been one of our foundation supporters here. Her academics at New Century advisor, of course, iconic on measuring slowdowns in America. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Priya Misra here on a jobs day. Folks, it's a non-jobs day. But as Priya, as you and I were talking, the dynamics of full faith and credit is price up and yield down. What's the x-axis look like? When is the when of lower yields?
So rates have been declining in the last few months. If you compare it to, say, where we were at the start of the year or even after Liberation Day, when the concern was inflation may skyrocket, the Fed may not be able to cut at all, there may be the sell America trade, what happens to the deficit? So that's how the 10-year got above 4.5. Why has it come down? Well, inflation has not picked up as much. So I think that's allowing the Fed to at least reduce the level of restruction. And the deficit is marginally better because we are taking tariff revenues.
It's the second time this week we've heard this. Mm-hmm.
The tariff revenues are improving the deficit, not the long run entitlement issue, but at least near term. So, I think 375 to 4.25 is our range for now. So it is below where we are right now. We like owning duration. One of the things, the reason we like it is, even though you're in that range, there's asymmetry, meaning there's more of a case of rates to fall if you get either permanent layoffs due to the shutdown or a slowing in, the job market continues. There's a non-linearity. I know, Tom, you like to talk about non-linearities in the job market. Typically, when the unemployment rate starts to go up, it goes up much faster. So for that asymmetry, we like owning duration.
Sign a control room, put me in the timeout chair. I didn't introduce Ms. Misra correctly. Priya Misra, folks, Core Plus Fund at JPMorgan Asset Management.
Very good. The markets seem to be ignoring the shutdown, it seems like. And is that something that is reasonable from your perspective, given what could happen, I guess?
So historically, shutdowns have been a bit of political theater. Okay. So the market ignores it. President Trump signed something in law saying that they will, in 2019, saying that people will get back pay. So you don't get paid whether you're working or furloughed, but you will get paid at some point. If it's a short shutdown, I think it's fine for the market to ignore it. Why it could be a little bit different this time is we've not historically heard during a shutdown that the administration may actually have permanent layoffs. Yep. Now, maybe it's a negotiating stance, but if it actually results in permanent layoffs, I think the market's not going to ignore it. And the other one is how long does it last? You know, if it's a short shutdown, you don't really miss a paycheck, it's okay. You start to miss one or two paychecks, the military starts to not get paid. They're putting their lives on the line. I think then the market's going to say, okay, Congress has to get their act together. I think then the market will start to increase risk premiums, and you'll see an impact in rates and you'll see an impact in the equity market.
All right, so we're not getting the non-farm payroll data today, but neither is the Fed, I'm assuming, unless they get somebody passes them a note under the desk. So they're kind of flying blind a little bit too. So how does that, if we go a week or two and they're not getting the data that they need because they are data dependent, how do you think the Fed, how does that impact the Fed, do you think? Right,
great point, because this Fed has said time and time again that they're data dependent. They don't want to rely on a model. They want to base it on data. But, you know, payrolls is a very important data release. So is claims, so is CPI. But if we don't have that, we look at what we call second tier data releases. And on the labor market, I actually think there's been a remarkable amount of consistency. Mm-hmm. We're not seeing the layoffs, but we are seeing low hiring, whether it's surveys, whether it's, you know, actual hiring trends in the last few months. So I think the Fed looks at the totality of the data and says there's some risks to the labor market building. This is why they cut in September, the risk management argument. I think you can make that case for an October cut as well. I think given that BLS is not collecting data, we shouldn't really expect a very reliable, you know, October payroll report as well. So I think this might be, for the next few months, they're going to have to look at a lot of other data. I think given the starting point, we're at 4.25 on Fed funds. They can cut a few more times before it starts to get difficult for them, because now you're in the vicinity of neutral. Now you need a much better, credible sense of data.
How do you respond? And I believe Governor Myron, Cy, help me here. We got Governor Myron in the 9 o'clock hour, I think. There's a raging debate, fabulous Tom Orlick article in Bloomberg yesterday on the neutral rate, the plugins of the Taylor rule, and that. It's tangential to what you do. But when you synthesize Feroli and Kasman and Priya Misra, is there anything we can believe in the neutral rate, or is it just a fog out there? You should see the fog. The fog on Park Avenue comes down.
Sure.
And, you know, it avoids the JPMorgan building.
Yeah, they've got a
special fog remover.
It is a very nice building.
Is there a fog in our neutral rate analysis?
So there is always large amounts of uncertainty around the neutral rate. It does move with structural reasons. So there's been this argument for the last few years that the neutral rate is higher because corporate and business balance sheets are better, that there's more fiscal expansion. And then Governor Myron's making the point that actually it's going down because of tariffs and lower immigration. I think we're not going to know. But what I am taking away from that is whether it's 3 or 2.5, Fed funds is at 4.25. You're not hearing much from people saying, actually, policy is not restrictive. I think this will be the key question next year. If the Fed cuts 3-4 times, they get into the vicinity of neutral, which I would say is 2.5 to 3.5. That's how we're thinking about it. And so they can still cut for now and then watch to see how do different parts of the economy respond to interest rates. That's going to be the best metric of how neutral, how restrictive are rates. Mm-hmm. And it's going to vary. If you're in AI investment, it may not be that restrictive. Housing, it's very restrictive.
Paul, so it's Three Stooges monetary policy, step by step, inch by inch.
Exactly. Continue. Priya, if I'm a credit analyst in the Core Plus Bond Fund, do I even bother to get up from my cubicle, go to your corner office and pitch you ideas? Are you open to taking credit risk?
Oh, absolutely. So we do like credit risk. We think we're in a sub-trend growth environment, 1% to 2%. So, you know, the overall macro picture is positive for risk. Company fundamentals look fabulous. I mean, a few months ago, I was nervous that do company margins come down because they absorb tariffs? We haven't seen that. They've absorbed tariffs and they've managed to keep margins high. So company fundamentals are strong. But here's why I need to talk to the analysts all the time. Dispersion is increasing. Whether it's securitized credit, whether it's investment grade credit with LBO risk, whether it's high yield, you are seeing some defaults. So we need the analysts, we need the research to do the work, not just at the broad sector level, but at the company level, and then tell us this is what you overweight, and importantly, this is what you underweight.
Can I beg? We'll give you 3 segments. We'll blow out an hour. I want you to come here. The guy or the woman walking into your office, as Paul brilliantly describes, who's looking at private credit, the shadows there, the new CMBS tranches and all that. Bring that mathematical beast with you. The two of you together would be a real surveillance treat. That would be really great.
I like that. Yeah, I think I like that you bring up CMBS, because there you don't just have to look at the collateral. You have to look at the collateral, the servicer, the structure, and see which tranche you're buying. So it requires a lot of work.
We're going to make that happen. I think Eric's he lost so much money last night in the game. I'm not sure he's listening. Priya Misra on a non-jobs day. Thank you so much. She is with JPMorgan Asset Management. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
The last time Tiffany Wilding was on, folks, she was riveting. I cannot, it's a blur, folks. Like Paul and I stagger from guest to guest, but I have the clearest memory that she just absolutely nailed the tension out there, is witnessed by price and yield in the American economy.
Absolutely. Tiffany Wilding joins us. She's an economist for North America for PIMCO. Tiffany, we're not getting the economic data that we're used to getting, that the market kind of feeds off of. So let me ask you to step back and just kind of give us your 30,000-foot view that you share with your clients these days about this U.S. economy.
Yeah, well, I think taking a step back, what we've noticed is that the economy is behaving, somewhat differently than I think most people expected, just given the various policy pivots that the Trump administration has implemented. So obviously we've gotten really large tariff increases. We have immigration policy U-turns. We have various other things, and I think the surprising thing for many is that the manifestation of those policy changes in the economy would be through price level adjustments. And I think what we're seeing as we go through the year and we're gaining more information is that companies aren't necessarily increasing prices by as much as people expected. They are doing it on the margin, but they're also trying to reduce costs. And part of the way that they're reducing costs is they're just maintaining their labor costs, or they're even trying to actually reduce labor costs. So we've seen a pretty material deceleration in labor market activity this year. We think that part of the reason why they're choosing to do this is that you have clashing forces. You have this immigration U-turn. There's less labor supply, less people coming into the labor market, but you also have this technology boom that's happening in the background. And so they're trying to figure out how can we save money through implementation of technology, and we think that's also having an effect here. So I think that's why you're seeing more concern out of Federal Reserve officials more recently. We think it's why they took the first step to start lowering interest rates again in September. And ultimately, we think that will be a reason for them to cut a couple more times this year as that labor market stays weak. But 2026, I think, does look a lot better as you get some more of the one big beautiful bill stimulus that's hitting the economy to offset all of this.
Yeah, that's kind of where I wanted to go, Tiffany. Tiffany, about 2026 and the tax cuts, the credits, those things that were in fact included in that tax bill. Are you putting that into your model in 2026 as a driver of this economy?
Yeah, I mean, so if you look at, the tax cuts were retroactive, which means that, both businesses and households will get a one-time larger check. You're seeing that in the business tax data already that the Treasury publishes, but you're also going to see it when households file for refunds early next year. The refund checks are going to be large, especially those households that work jobs that where they work overtime, any taxes paid in 2025 on overtime is basically going to be rebated back to them at the beginning of 2026. So that's going to be a pretty large refund check in addition to the enhanced child tax credits, et cetera.
Yeah.
So we think that will help. It's a one-time thing for sure, in terms of the retroactiveness of it, but it will help to sort of bridge the economy through this period of weakness, we think, as you have the tariffs that are also starting to bite.
Ken, our global technical director, wants to know if he can, the rebate he's going to get for overtime.
Yep.
I mean, is that incoming?
Boom.
Boom. I think it's going to be brilliant. Tiffany Wilding with us with PIMCO. Tiffany, I just brought up Atlanta GDP now, 3.842%. I did a regression back to the end of 2022, the Ardeni Ancampora low. And the answer is we're plus a solid 1.2 standard deviations. We've been there. This is the third time. I mean, is that a one-off kind of boom? Do you think it just pulls back? Or do we just completely misjudge the sustained real GDP, as Torsten Slok of Apollo mentioned earlier this week?
Yeah, well, I think we got really good news with the recent revisions to second quarter GDP, which also included, what the BEA calls annual benchmark revisions, and they new data that's more complete that is included in that. And one of the big things that was revised higher was the savings rate over the last several years. So it just suggests that consumers have a bigger buffer here. We've been talking about this sort of K-shaped economy now for a couple of years, where you have higher end consumers that have higher wealth as a result of increasing housing prices and equity markets since the pandemic, et cetera. And so you have consumers that have a bigger buffer coming into this period, and that argues for them just to be more resilient. We think that the resilience in the consumer that you're seeing is related to that. Ultimately, we think you still will see some slowdown in the fourth quarter, but the consumer looks better.
Tiffany, I'm sorry, I wasn't focused there. Anne-Marie Horton just came up to our gorgeous studio and placed her New York Yankees jacket, like the one Lisa has, on the glass wall.
Wow.
I didn't hear a word Tiffany said. I was so rattled. Tiffany, I got an average line. And that regression of Atlanta GDP now, the average line back to the Ardeni Ancampora stock market low, October 2022. Ready, Paul? 2.6% is average. Have we just misjudged, Tiffany, the boom that we're in because of technology?
Yeah, well, so I think that you're absolutely right. Growth has been, since the pandemic, closer to 2.5% to 3%.
Nailed it.
But we think one of the reasons why that's happening is because over that period, you also had an immigration boom that was happening. And that people come into the country, they consume, they not only work, but they consume. And so you had those inflows that were also resulting in higher growth performance. So we do think that part of the reason why growth was so elevated in that period, that is coming off now as you have a U-turn in that policy. So we think the underlying level of growth in the U.S. economy has stepped down from that 2.5% to 3% pace, to something closer to 2% where we were pre-pandemic. And then I think the broader question is how much is the technology-related investment trends that we're seeing associated with AI, how much room does that have to run, and how much of a boost could we have from that? And we think that there is some room for that to run. It does look like we're in the early stages of that, even though the equity markets have been trading that theme for quite some time. The actual investment that we're getting in terms of data centers, and the hard investments, we think that is actually just kind of more in the early days here. So that has some more room to run.
Tiffany Wilding, thank you so much. Love when you come on. Economist,
thank you.
North America at PIMCO, just absolutely brilliant.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.